Okay, so let's set the scene. Imagine it's early February 2026. You wake up, you pour that first cup of coffee, and you do what we all do, right? You check your phone,
You check the brokerage account first.
of course. And what you see looks, well, it looks like a typo.
Yeah.
It seems way too good to be true. Tech stocks are just ripping higher.
Absolutely flying.
Valuations for anything with AI in the name are hitting numbers that, frankly, sound like they belong in a science fiction novel, not a Wall Street terminal. There's this overwhelming feeling that the party is back on.
The liquidity party of 2021, it feels like that all over again.
Exactly. But then you make the critical mistake of turning on the news or, scrolling past the stock tickers.
And that's where the headache starts. That's the moment of cognitive dissonance.
Right. Because if you only look at the screen showing your portfolio, it's pure euphoria. But if you look at the screen showing the physical world, it looks like it's, I don't know, catching fire.
It's the ultimate split-screen reality. I was reading through the source material for this deep dive, and it's this incredibly high-level market briefing generated for macro strategists. It covers this critical 72-hour window from February 8th to February 10th.
The kind of document that pension fund managers and sovereign wealth funds use to make billion-dollar decisions.
Exactly. And the tension, the cognitive dissonance is just jumping off every single page. It's palpable.
And that is precisely what we're here to unpack today. We're going to do a deep dive into this specific market briefing. This isn't some blog post or a news article. This is the real deal, the kind of analysis that, usually stays behind a very expensive paywall.
And the people reading it, you can tell their hair is on fire. Even if the S&P 500 is, chilling at all-time highs, they're trying to square this circle.
They're stressed because they have to manage this collision.
Yeah.
And I think that's the perfect word for it.
It really is the central theme of the entire document. It's the collision between narrative on one side, the story the market is telling itself.
Which is what? AI fixes everything and money is free again.
Basically, yeah. Tech is booming, risk is on, don't miss out. That's the narrative. But it's colliding with the hard data, what the numbers are actually saying.
And the numbers are saying what?
They're flashing red.
Yeah.
On inflation, on wages, and on the simple fact that the geopolitical temperature is, it's boiling over.
So we're calling this one the market's tipping point because it really, really feels like we are standing on the edge of something. We need to decode how a single election in Japan, a lawsuit over weight loss drugs in, Delaware, and a bridge in Detroit are all actually part of the same story.
And they absolutely are. They're all different chapters in the same book. And a book is about the rising cost of doing business in a world that is actively fracturing.
Okay, so let's start with the money. Let's start with the euphoria. Before we get into all the scary stuff about bridges and blockades, we have to understand why the market was partying so hard on Monday morning. And the weirdest part is, the party didn't start on Wall Street.
No, it didn't. It started in Tokyo on a Sunday.
On a Sunday.
That's right, Sunday, February 8th. This was the Japanese general election. And I get it, for a lot of our listeners, Japanese politics might sound incredibly dry or, irrelevant.
The distant, yeah.
But I promise you, if you want to understand why a company like Nvidia is rallying on a Monday morning in New York, you don't start by looking at Silicon Valley. You have to start by looking at the LDP headquarters in Tokyo.
Okay, so the election results came in, and the briefing describes them as decisive.
Decisive is putting it very, very mildly. Sana Takaichi and her party, the LDP, the Liberal Democratic Party, they didn't just win, they absolutely crushed it.
So what are the numbers? What does a crushing victory look like?
We're talking about a seat count somewhere between 274 and 328 seats. In a parliamentary system like Japan's, that's not just a win, that is a blank check. That is a popular mandate to reshape the entire economy however they see fit, with very little opposition.
A blank check. Okay, so for the listener who, like me, maybe hasn't been tracking the internal machinations of the Japanese Diet, who is Sanai Takaichi, because this briefing document, it refers to her specifically as the spiritual heir to Abenomics. That sounds really significant.
It's huge. It's probably the single most important takeaway from the election. You remember Shinzo Abe, right? His whole economic philosophy, which the world dubbed Abenomics, was built on what he called the 3 arrows.
Right, the 3 arrows. Let's refresh that.
First arrow, aggressive monetary policy, just, print a ton of money to fight deflation. Second arrow, massive fiscal stimulus, government spending on infrastructure, you name it. And the third arrow, which was always the trickiest one, was structural reform.
So basically, print money, spend money, and hope for the best, while also trying to reform the economy.
That's the gist of it. The goal was to keep the massive Japanese export machine, think Toyota, Sony humming along. Well, Takaichi is seen as that, but arguably intensified. She's the turbocharged version.
More aggressive.
Much more. She's an ultra-conservative nationalist who has been very, very clear in her belief that the Bank of Japan should not only keep interest rates at rock bottom, but that it should do so pretty much indefinitely, regardless of what the U.S. Federal Reserve or the European Central Bank is doing.
So she's a hawk on national issues, but a massive dove on monetary policy.
She's a fiscal hawk's worst nightmare and a liquidity junkie's absolute dream. She basically believes the central bank's job is to finance the government's ambitions, period.
So the global markets see her win this landslide victory on Sunday night, and the immediate thought is, what?
The immediate thought is, okay, the money spigot is staying wide open. Not only is it staying open, they're probably going to crank it even harder.
And the reaction of the markets was immediate.
Instantaneous. Before the U.S. market even thought about opening, the Nikkei 225 index in Tokyo just soared to record highs. But that's the local story. The more important signal for us, sitting here in the West, was what happened in the currency markets.
The yen.
The yen just started crumbling. It began a nosedive, and it's now approaching 160 against the U.S. dollar.
160. That sounds like an extreme number. Is that historic?
It is historic territory. It's the kind of level that usually forces the central bank to intervene, to step in and buy yen to prop up its value. But the market is making a bet here.
And the bet is?
The bet is that with Takaichi in charge, there won't be an intervention. They are betting that she actually wants a weak yen. She wants it to be cheap because it makes every Toyota Camry and every PlayStation 5 sold abroad that much more profitable for Japanese companies.
Okay, but here's the part I really want to drill down on because it's so crucial. Why does a cheap yen in Tokyo trigger a rally in, say, Microsoft or Apple in Cupertino? What is the actual mechanism there?
It unleashes one of the most powerful and sometimes dangerous forces in all of global finance. It's called the carry trade.
The carry trade. Okay, let's unpack this. This is one of those terms that gets thrown around on financial TV all the time, but I feel like a lot of people just nod along without really getting the mechanics of it.
It's actually a pretty simple arbitrage at its core. Imagine you're a big hedge fund. You can walk into a bank in Tokyo and borrow, let's say, $10 million worth of Japanese yen.
Okay.
Now, because Sanai Takaichi, the Bank Japan, are ensuring interest rates are effectively zero, you're paying maybe 0.5%, 0.5% in interest on that massive loan. It's almost free money.
So I've got my hands on a huge pile of very, very cheap yen. What do I do with it?
Right. You don't want to hold yen because its value is falling. So you immediately take that yen, you convert it into US dollars, and then you buy an asset that pays you a higher return.
Like what?
Well, the safe version of the trade is you buy a U.S. Treasury bond that's paying, say, 4.5% interest. You're borrowing at 0.5% and lending to the U.S. government at 4.5%. You just pocketed a 4% profit for doing absolutely nothing but moving money from one currency to another.
And that's the safe version.
That's the safe, boring, institutional version. The risk-on version, the one that moves markets, is you take that borrowed yen, convert it to dollars, and you go buy Nvidia stock. Or you buy high-yield corporate debt, or you plow it into the latest AI startup, or you buy Bitcoin.
So Japan is effectively acting as the zero-cost funding source for the rest of the world's gambling habit.
That is a perfect way to put it. Japan becomes the global ATM, and when Takaichi won that election, it was like a giant neon sign was lit up over Tokyo saying the ATM is open for business and the transaction fees are zero.
So the liquidity floodgates just burst open Sunday night European time. And all of that money has to find a home somewhere.
It has to go somewhere, and it flowed right into global risk assets. This is the fundamental reason why, despite all these terrifying headlines about bridges and wars that we're going to get to, Monday morning started with a massive risk-on rally.
The market wasn't looking at the geopolitical risk map.
No, it was looking at the liquidity injection map, and the source was Tokyo.
That explains so much. You see these headlines about a potential trade blockade or a new conflict, and you're scratching your head wondering why the S&P 500 is up 1.5%. It's because there's just so much cheap money sloshing around the system looking for a home.
It creates this cushion. It's what some traders call the Takaichi poop, if you will. Investors feel insulated from bad news because there's just so much new capital entering the system every day. It creates a buffer where, bad news is temporarily ignored because the cost of leverage is so low.
Which brings us perfectly to Monday, February 9th, the risk-on rally. The mood, as described in this briefing, was euphoric. And the epicenter of that euphoria was, once again, artificial intelligence.
Of course. It's the narrative that just refuses to die. It's the only story in town.
And we got a huge piece of news that dropped validating that narrative. It was about a company called Databricks.
Yeah.
Walk us through this, because the numbers here are starting to sound, I don't know, fake.
They do sound fake, but I assure you the wire transfer was very real. Databricks, which is a massive, massive player in the data and AI infrastructure space. It's not a consumer company. It's a picks and shovels kind of company.
Right.
They raised $5 billion, a $5 billion funding round. But that's not even the headline. The headline number is the valuation they raised it at, $134 billion.
$134 billion for a private company, one that isn't even on the stock market yet.
Just to put that number in context for you, that valuation makes Databricks, a private company, bigger than Intel. It's bigger than IBM. It's approaching the size of these huge legacy industrial pillars of the American economy, like a Union Pacific Railroad or Honeywell. And this is a company that, at its core, sells data architecture software.
So for those of us who aren't data engineers, what does Databricks actually do that makes it worth $134 billion?
Yeah. So traditionally in the world of big data, you had two kinds of storage systems. You had data warehouses, which were for your neat, structured data. Think of Excel sheets, sales numbers, things that fit nicely into rows and columns.
The clean stuff?
The clean stuff. And then you had data lakes, which were for all the messy, unstructured data, videos, audio files, social media posts, server logs, just a giant, messy swamp of information. Databricks was a pioneer of what they call the lake house, which is an architecture that combines the two.
Okay, that sounds really useful, but $134 billion useful?
Yeah.
What's the AI angle?
The valuation isn't just about data storage. It's about the future. It's about AI. Databricks has positioned itself as the essential pick and shovel play for enterprise AI.
What does that mean, pick and shovel?
It means if you're a Fortune 500 company, let's say you're JT Morgan or Coca-Cola or Ford, and you want to build your own internal proprietary AI model, you can't just feed all your secret sauce, all your trade secrets into a public model like ChatGPT.
Right, you'd be leaking all your data.
You'd be giving away the keys to the kingdom. So you need to build your own. And to do that, you build it on a platform like Databricks. They provide the infrastructure to manage the data, train the models, and deploy them securely.
So this massive funding round is effectively the market screaming, the corporate AI spending boom isn't over.
That's precisely it. There was a little bit of fear creeping in during the last quarter of 2025 that maybe the AI hype was cooling off, that maybe CEOs were starting to tighten their belts because they weren't seeing the return on investment just yet.
The prove-it stage.
Exactly. But when you see the so-called smart money, the big institutional investors, the private equity giants, pouring $5 billion of cash into a private deal at that valuation, it sends a powerful signal to the public markets.
And the signal is?
The signal is the boom is real. The infrastructure build-out is not over. Companies are still writing massive checks for this stuff.
It's a huge confidence booster for the whole sector. If the smart money is willing to bet that much on a private company like Databricks, then buying Nvidia or Microsoft or Google on the public market suddenly feels a lot safer, doesn't it?
It validates the entire ecosystem. It tells the Nasdaq that the growth engine is still firing on all cylinders. And it anchors the valuations for everyone else. If Databricks is worth $134 billion, then maybe a public company like Snowflake or Palantir starts to look cheap by comparison.
And there's always a but in these briefings, isn't there?
It's my job to find the but.
While everyone is popping champagne over Databricks and the free money from Japan, something else was happening on Monday. Something a little weird at the Federal Reserve.
Weird is the perfect word for it. They held a closed-door meeting on Monday at 11:30 a.m. Eastern Time.
Now, I know the Fed has meetings all the time, but this was specifically noted in the briefing as being held under the Sunshine Act. What does that even mean?
So, the Sunshine Act is a law from the 70s that basically requires transparency for government agency meetings. It says, you have to do your business out in the open, in public. However, it has specific exemptions. It allows for closed meetings under certain circumstances, usually when they're discussing sensitive financial information that could, move markets if it were leaked prematurely.
So the secrecy is a feature, not a bug.
Right. And usually these closed-door meetings are for really administrative, boring stuff They'll discuss the discount rates, which is the rate that commercial banks pay to borrow directly from the Fed in an emergency. It's the plumbing of the financial system. It's usually not a big deal.
But the context here is everything.
The context is everything. Holding one right now, in this climate, on a random Monday morning when the markets are screaming at all-time highs, it gets the rumor mill turning.
It injects a dose of paranoia into the system.
A huge dose. It adds this layer of nervous speculation. When the Fed closes the doors and pulls the shades, the market starts whispering. What are they talking about? Are they seeing something in the banking sector that we aren't? Is there a specific bank in trouble? Is a new regulation coming? Are they worried about liquidity in some dark corner of the market?
We are going to get to some actual bank scandals in a minute, because of course there are some. But it's this paradox that I really want the listener to sit with for a moment. Yeah, this split screen again. On one hand, you have Databricks and Japan screaming, "Party on, money is free."
Full speed ahead.
And on the other hand, you have the most powerful central bank in the world locking the doors and having a hushed, secret conversation, presumably about financial stability.
It's the tension between the surface-level party and the structural cracks that might be forming in the foundation. The penthouse is having an absolute rave, but someone thinks the basement might be flooding.
Speaking of cracks in the foundation, let's zoom in. We've been talking really macro Japan, the Fed, billions of dollars. Let's talk about a specific corporate battle that tells us a huge amount about the economy right now. I'm talking about the Ozempic economy.
Ah, yes. This was a fascinating and very brutal series of events that unfolded over the weekend. It's a classic David versus Goliath story. Hims and Hers versus Novo Nordisk.
Okay, so Hims and Hers is that telehealth company, right?
Yeah.
You see their ads all over Instagram and podcasts.
Yeah.
They started out selling, like, hair loss pills and erectile dysfunction medication?
Correct. Very direct to consumer. And recently they pivoted extremely hard into the weight loss drug market.
The GLP-1 drugs.
Exactly. The Wegovy's and the Ozempics of the world, they've been riding that massive wave. And their angle was this. Because there has been such a huge, well-publicized shortage of the brand name drugs, the FDA invoked a special rule. This rule allowed what are called compounding pharmacies to make generic-like versions of the drug to fill the gap.
Okay, so Hims and Hers wasn't selling actual Wegovy, but a compounded version of the active ingredient.
Precisely. And they were making an absolute fortune doing it. It was the core of their growth story for the past year. Their pitch was, get the same miracle result for a fraction of the brand name price. It felt like a classic tech disruption of a legacy industry.
It did. It felt like they found a clever loophole. Until Sunday?
Until Sunday.
What happened on Sunday?
Hims and Hers put out a press release, very abruptly, announcing they're immediately stopping the sale of the compounded version of Wegovy.
Why?
A couple of reasons. First, the FDA officially declared that the shortage of the brand name drug was over, which meant the legal justification for selling the compounded version was disappearing. And second, and more importantly, Novo Nordisk, the Danish pharma giant that owns the patent on Wegovy, was coming for them with an army of lawyers.
And then Monday morning, bright and early.
Novo Nordisk sues them for patent infringement.
Ouch. And the stock market's reaction to this 1-2 punch.
A total bloodbath for Hims. The stock crashed 18% in a single day. It just got obliterated.
So what is the big takeaway here? Aside from the obvious, which is don't mess with big pharma.
The lesson is a really important one for investors. It's about economic moats. You know, Warren Buffett's favorite concept.
The competitive advantage that protects a company.
Exactly. And investors fell in love with Hims and Hers because they looked like a classic disruptor with a strong brand and a great app. But their moat, their entire business model in this lucrative category, was built on a temporary regulatory loophole, the FDA's shortage list. Once that loophole closed, their moat just evaporated overnight.
It's a huge reality check on that generic disruptor model.
It is. It's a stark reminder that in industries like biotech and pharma, intellectual property and patents are the ultimate castle walls. You can have the best marketing in the world, the slickest app, the happiest customers, but if you don't own the molecule, you are essentially just renting your business model from the company that does.
And Novo Nordisk very much owns the molecule.
They own the molecule, and they have the billion-dollar legal budget to protect it. This is a classic example of regulatory capture working in favor of the incumbent. For anyone listening who's investing in these kinds of companies, it's a huge warning sign. You have to check the foundation of the business. Is their success based on their own durable innovation, or is it based on a temporary gap in the market that can be slammed shut?
And speaking of shaky foundations and corporate risk, there was another much smaller but darker blip on the radar screen in the banking sector regarding UBS, right?
Yes, this was buried in the news cycle on Monday, but it's very significant for the banking sector and for regulators. Reuters broke a story that UBS, the giant Swiss bank, is under scrutiny for moving millions of dollars for Ghislaine Maxwell.
The Ghislaine Maxwell, Jeffrey Epstein's notorious associate.
The very same. And the really, truly damaging part of the allegation is that these transactions allegedly happened after Epstein's arrest in 2019.
Oh, wow.
Hmm.
That is not just a bad look. That's a catastrophic compliance failure.
It's beyond catastrophic. Every single bank in the world has incredibly strict KYC, know your customer, and AML, anti-money laundering rules they have to follow. If you are found to be moving money for a high-profile, publicly known associate of a convicted sex trafficker who is currently in jail, that suggests a complete and systemic failure of your most basic controls.
And this connects right back to that mysterious closed-door Fed meeting, doesn't it?
Yeah.
It adds to the speculation.
It certainly adds to the smoke. It's not proof of anything. But if you're a regulator and you're seeing stories like this, that one of the world's biggest and most important banks is failing such a basic compliance test on such a high-profile client, you start to wonder what else is broken.
You start to think maybe you need to tighten the screws across the entire industry.
Exactly. And that increases the cost of doing business for every single bank. It means hiring more lawyers, more compliance officers, which means less capital available for lending. It's another form of friction.
So, okay, let's recap where we are. We've got Japan printing money like there's no tomorrow. We have U.S. tech spending that money on the AI dream. And we have pharma giants crushing their smaller competitors. That's the financial and corporate layer of the story.
A very bubbly, risk-on layer.
But now we need to look at the physical map of the world. Because while all this digital money is flowing freely and instantly across the globe, the physical world is getting blocked off. It's getting clogged up.
This is the section of the briefing that honestly worries me the most. This is the geopolitics, the friction points.
And we have to start in our own backyard.
Yeah.
We have to talk about the bridge.
The Ambassador Bridge, or more specifically, the new Gordie Howe International Bridge that's being built to supplement it, connecting Detroit, Michigan, and Windsor, Ontario.
The source material here explicitly mentions President Trump. So we are clearly operating in a scenario where he has returned to office or is holding significant political sway. What is the specific threat that's being made?
The threat is, in a word, a blockade. The briefing states that Trump is threatening to block the opening of this brand new multi-billion-dollar bridge and is demanding a complete renegotiation of trade terms with Ottawa.
This isn't just about a bridge, though. I mean, this isn't just a headache for commuters. This specific corridor is the single busiest trade corridor in all of North America.
It is the absolute jugular vein of the North American auto industry. You have to understand how modern manufacturing works, especially for cars. It's all just-in-time delivery.
Explain that. What does that mean in practice?
It means a single part, like a seatbelt bracket, might cross that border 4 or 5 times before a car is finished. It crosses as raw steel from the U.S. to Canada. It gets stamped into a part in a Canadian factory. It crosses back to the U.S. to be painted. It crosses back to Canada to be put into a seat assembly. Then the whole seat assembly crosses back to a factory in Michigan to be put in the final car.
So if you block that bridge, or even just threaten to slow it down, you aren't just annoying Canada. You are actively shutting down assembly lines in Michigan, Ohio, Indiana.
Immediately. Within hours, you throw sand into the gears of the entire North American manufacturing economy. It creates immediate and severe supply shocks. Parts don't arrive. Factories have to idle their lines. Workers get sent home without pay. And the price of the cars that do get made goes up.
It's stagflationary. It's the worst of both worlds.
It is the dictionary definition of a stagflationary shock. You kill economic growth by stopping the factories, and you simultaneously increase inflation by forcing all that logistics into slower, much more expensive routes, or by creating shortages.
And what does a threat like that do to the financial markets?
It hammers the Canadian dollar, the CAD, immediately. And it hits any stock related to that trade. The railways like CN Rail and Canadian Pacific, the trucking and logistics companies, and of course the auto manufacturers themselves like Ford and GM and Stellantis. It introduces profound friction into a system that is built to rely on seamlessness.
It's the complete opposite of the tech boom narrative we were just talking about. AI is supposed to be frictionless and global. A bridge blockade is pure, physical, brute force friction.
And it's not just in North America. The briefing points to other hotspots. Look at the Caribbean.
Cuba.
Right. There are reports circulating that Cuba is unable to refuel international airplanes because of tightening U.S. sanctions. And in this scenario, Trump is threatening secondary sanctions and tariffs on any country or company that sells oil to Cuba.
So weaponizing the energy supply chain.
Yeah.
Squeezing their access to fuel.
Exactly. It's another choke point. And then you look halfway across the world to Hong Kong.
The Jimmy Lai sentencing.
Jimmy Lai, the pro-democracy media tycoon, sentenced to 20 years in prison. The source document calls this the symbolic end of the national security trial era in Hong Kong. What it really means is that Beijing has now solidified total and complete control. The idea of Hong Kong as a semi-autonomous, law-based bridge between East and West is legally and symbolically over.
So if you're a strategist and you step back and you just look at the map of the world on this Monday morning, Detroit is threatened with a blockade. Cuba is being squeezed of energy. Hong Kong, a former financial hub, is locked down. And we already know the Red Sea is effectively a no-go zone for shipping.
The world is fragmenting. The cost of moving physical goods is rising. The geopolitical risk premium should be going up. This is the extra cost that should be priced into assets to account for doing business in a dangerous and unpredictable world. But, and this is the kicker, the stock market is completely ignoring it.
Because of the liquidity. Because of the cheap money from Japan.
Because of the liquidity.
Yeah.
The market is effectively saying, I don't care if the bridge in Detroit is closed, as long as the yen is cheap and Databricks is growing at 50% a year.
That feels deeply, deeply unsustainable. It feels like a massive bubble of denial.
It is a bubble of denial. You have the financial economy living in the frictionless world of 2021. And you have the real economy living in the high-friction geopolitical world of the 1970s. Eventually, that friction costs real money. Eventually, the blockade stops a company from making its quarterly earnings number.
Which brings us to the main event, the day the bill comes due. The Super Data Day, which is Tuesday, February 10th. Today in the timeline of this briefing.
This is the moment of truth. This is where the rubber meets the road. We move from the narrative of the past 48 hours to the cold, hard, unforgiving truth of the economic data.
And the briefing highlights what it calls a trinity of volatility, all hitting the market on the same morning. 3 major data points. Let's take them one by one. First up, the ECI.
The Employment Cost Index.
Okay, why do we care about this specific acronym? We hear about jobs reports and average hourly earnings all the time. Why is this particular metric the Fed's favorite?
That's a great question, because average hourly earnings can be really misleading. Imagine you run a factory with 90 low-wage workers and 10 high-wage managers. If you fire 20 of the low-wage workers, the average wage at your factory will shoot up, even though nobody actually got a raise.
Ah, okay. It's a math quirk, a compositional effect.
Exactly. The ECI is designed to fix that. It tracks a consistent basket of jobs, so it accounts for those changes in the mix. It tries to answer a purer question. For the same employee doing the same work, are companies having to pay them more? It measures the pure underlying cost of labor.
And if the answer to that question is a resounding yes,
then the narrative that inflation is dead is itself dead. It means inflation is sticky because wages are the stickiest component of inflation. And if the ECI number comes in hot, meaning wages are rising faster than economists expected, it completely destroys the inflation is over story that the market has been banking on.
and if that story dies, the whole house of cards could come down.
Bond yields would shoot up immediately. And when bond yields shoot up, the valuation of everything else has to come down. Stocks, especially those high-flying, long-duration tech stocks we just talked about, usually crash. It's a direct seesaw. A hot ECI is poison for the stock market.
So data point number one, we're all watching the ECI print. If it's hot, that beautiful rally fueled by Japan might just evaporate in a matter of minutes.
It would force the Fed's hand. It would kill any hope of interest rate cuts. It would tell Fed Chair Powell, your job isn't done yet. You haven't beaten inflation.
Okay, second data point in the Trinity. Import and export prices.
And this connects right back to that messy geopolitical map we were just talking about. We know that shipping through the Red Sea is a disaster. We have the U.S. Department of Transportation explicitly warning commercial ships to stay away from Iranian waters.
So ships are being forced to take the long way around, going all the way around the Cape of Good Hope in Africa, burning more fuel, taking more time, paying higher insurance premiums.
And all of that costs money, a lot of money. The question this data point answers is, has that cost started to hit our shores yet? The import price index will tell us that. If we see a sudden spike in import prices, it means supply chain inflation, is back.
It's the 2021 nightmare all over again, waiting for couches and cars.
It's that nightmare returning. And here's the really scary part for the Fed. They can't fix a broken supply chain by raising interest rates. If inflation is coming from Houthi rebels in the Red Sea or a trade dispute over a bridge in Detroit, the Fed raising rates doesn't open the bridge. It just makes the economic pain for everyone else worse.
The Fed has a hammer, but the problem is a naval mine in the ocean.
That is a perfect and terrifying image. Their tool is useless against that kind of problem.
All right. And finally, the third piece of this volatile trinity, the one that sounds the most boring but is actually in some ways the most critical, the 3-year Treasury auction.
Yes. The U.S. Treasury trying to sell $58 billion of its debt.
Now, why is this a risk? I thought buying U.S. government debt was supposed to be the safest thing you could possibly do with your money.
Usually it is. But the problem is quantity. The U.S. government is running massive deficits, which means it has to borrow a historic amount of money every single week just to keep the lights on. They do this by selling Treasury bonds at these auctions, and they need buyers to show up.
Who are buyers?
It's a mix. Big U.S. banks called primary dealers, foreign central banks like Japan and China, big domestic pension funds and investment funds. But recently, we've seen some of these auctions get a little wobbly. Demand has been a bit soft.
So what happens if not enough people show up to the auction? Or what if they show up but they demand a huge discount to buy the debt?
That's what the bond market calls a tail. Let's say going into the auction, the market expects the new 3-year bond to yield about 4.0%. But at the auction, the buyers are scarce. They say, no thanks, we're not interested unless you give us a higher yield. We'll only buy it at 4.05%. That extra 0.05% gap is the tail.
This sounds like a tiny number.
It sounds tiny to a normal person, but in the multi-trillion-dollar bond market, a 5 basis point tail is a 5-alarm fire. It's a vote of no confidence. It's the market telling the U.S. Treasury, we are becoming nervous about lending you this much money, and we are now demanding a higher premium to hold your paper.
And if that happens, what's the ripple effect?
It sucks all the oxygen out of the room for every other asset. If the risk-free rate, the rate on U.S. Treasuries, suddenly jumps up because of a bad auction, then every other asset has to reprice lower. Why would I take the risk of buying a volatile stock if I can suddenly get a much higher guaranteed return on a treasury? A bad auction can tank the stock market in minutes.
So, to summarize, Tuesday is the gauntlet. The narrative faces reality. We need wages to be cool, shipping costs to be low, and a whole lot of people to show up and enthusiastically buy U.S. debt. If any one of those 3 things fails,
the whole narrative collapses. The Takaichi put from Japan, all that cheap money, it might not be enough to save the market from a trifecta of bad news on the home front.
that is a tremendous amount of pressure packed into a single Tuesday morning.
It is. And you have to remember, the market is currently priced for perfection. It's sitting at record highs. It is absolutely not priced for a hot ECI number or a failed treasury auction. There's no margin for error.
So let's look past today. Let's look at the forward calendar and the briefing. The week of February 16th to the 20th. What's on the horizon after this super data day?
Well, the briefing notes that next week is choppy. For starters, Monday, February 16th is a holiday in the U.S.
President's Day.
Right, so the markets are closed. And that creates what traders call a liquidity gap.
Meaning what, exactly?
It means that if some crazy news event happens over the long weekend, let's say that bridge in Detroit actually gets fully blockaded, or there's a major escalation in the Middle East, there's no way for traders to react to it until the market opens on Tuesday morning. You are stuck holding the bag for 3 days.
So a lot of traders might just sell off their risky positions this coming Friday, just so they can sleep soundly over the weekend.
Exactly. It's called de-risking ahead of the event. And it means that when the market does open on Tuesday, it could gap down significantly if the weekend news was bad. There's no smooth decline. It's just an instant drop.
And then the big one lands midweek, Wednesday, February 18th.
The FOMC minutes.
Okay, so this is basically the detailed transcript of the last Federal Reserve meeting. It's old news in a way, but the market pores over it.
Yeah.
What are we hunting for in the fine print of these minutes?
We are hunting for one letter and one symbol, R star.
RSAR, the neutral rate of interest.
It sounds like something out of a sci-fi movie, but it's arguably the most important concept in modern central banking. It's the theoretical interest rate at which the economy is perfectly balanced. It's neither being stimulated to grow faster, nor is it being restricted to slow down. It's the Goldilocks rate.
And ideally, that's where the Fed wants to set its policy rate in the long run.
Correct. For the last decade, the consensus view was that Rystar was very, very low, maybe 0.5% after you subtract inflation. But there is a growing fear, a school of thought that's gaining a lot of traction, that Rystar has structurally moved up.
Why? What would cause that?
A whole host of things. Massive government debt, huge spending on the green energy transition, the AI productivity boom itself, deglobalization. All these things might mean that the neutral rate for the economy is actually much higher now, maybe 2% or even 3% in real terms.
Why does that matter for the average person with a mortgage or a car loan?
It matters more than anything else, because if the Fed decides the neutral rate is permanently higher, it means interest rates aren't coming down to where they were. Ever. Or at least not for a very, very long time.
So the dream of mortgage rates going back to 3% is just...
It's completely dead. It means business loans stay expensive. Car loans stay expensive. This is the hawk and the dove's nest scenario. If those FOMC minutes show that Fed governors were seriously debating a higher neutral rate, the market will freak out. It means high for longer isn't just a temporary slogan. It's the new permanent reality.
We also have some other key economic indicators coming out next week. The briefing mentions industrial output.
Yeah, this is the simple, is the real economy actually growing? Check. We know the stock market is growing. We know AI valuations are growing. But are factories actually making more stuff? Is the country producing more goods? If industrial output is flat or falling while the stock market is at record highs, that divergence is incredibly dangerous. It means the market is just buying a fantasy.
And for our friends up in the north, anything on the Canadian front?
Yes, Canadian credit data. The Bank of Canada releases a survey on credit conditions, and Canada is in a much tougher spot than the U.S. right now.
Why is that? Their economy is usually so linked to ours.
It's all about the mortgage structure. In the U.S., most people have a 30-year fixed-rate mortgage. You locked in at 3% in 2021, you're still paying 3% today. In Canada, almost all mortgages have to be renewed every 5 years.
Oh, wow. So all those people who bought houses during the pandemic are now facing renewal at much higher rates.
Exactly. The pain of higher rates bites the average Canadian consumer much, much faster and harder than it does in the U.S. So if this survey shows that credit is really tightening up, that a credit crunch is happening, then the Bank of Canada might be forced to cut interest rates aggressively way before the U.S. Fed even thinks about it.
Which would weaken the Canadian dollar even more, which in turn complicates that whole trade dispute with Trump over the bridge.
Everything is connected. The bridge, the mortgage rates, the currency, it's all one giant web of feedback loops.
So let's try to bring this all together. Let's synthesize this deep dive. We have a world where Japanese politics are fueling a massive global liquidity fire. U.S. tech companies are greedily capitalizing on that free cash to build the AI future. But the physical world, the world of bridges and shipping lanes and wage inflation, is threatening to crash the entire party.
That is the perfect synthesis. The financial economy is living in a frictionless digital utopia. The real economy is grinding its gears on the hard realities of geopolitics and inflation.
And usually those two realities have to converge at some point. They can't stay disconnected forever.
They always do. There's no escaping it. The only question is, which way do they converge? Does the real economy get a massive productivity boost from AI and catch up to the stock market's lofty expectations? Or does the stock market crash back down to meet the ugly reality on the ground?
That is the multi-trillion-dollar question. I want to leave you, the listener, with one final, slightly provocative thought to chew on as we wrap up.
Go for it.
We mentioned earlier that gold is up 2% during this period, and tech stocks are up massively, and Bitcoin is also up.
The everything rally, as they call it.
Right. But usually, gold and tech stocks do not hold hands and skip merrily higher together. They just don't. Gold is what you buy when you're scared. Tech is what you buy when you're brave and optimistic. They're usually inversely correlated.
That's classic portfolio theory. If you're buying gold, you are hedging against disaster, inflation, war. If you're buying Nvidia, you are betting on explosive future growth and productivity.
So if they're both rising at the same time, what does that mean? Are the markets really pricing in a booming risk-on economy, or are they pricing in something else entirely? Are they actually pricing in the devaluation of the currency itself?
That is the debasement trade. That's the heavy one. The idea that investors aren't saying Nvidia is worth more dollars. They're saying the dollar is worth less Nvidia.
Because the cash, the denominator in every equation, is being printed into oblivion by Japan, by the massive U.S. deficit, by virtually every major government.
If you come to the conclusion that the governments of the world have fundamentally lost control of their spending, and you just have to look at the deficit charts to argue that they have, then your only rational move is to own scarce assets. Gold is scarce. Bitcoin is programmatically scarce. And maybe, just maybe, high-quality AI infrastructure is the new scarce asset.
So the risk-on rally isn't about optimism at all. It's a panicked escape. It's a flight to safety, just a different kind of safety. It's a flight to safety from the printing press.
That is a very heavy thought. But looking at the global debt levels and that landslide Takaichi victory in Japan, it's a very plausible one.
On that cheery note, keep your eyes glued to that ECI print today. It might just tell us if that printing press is about to finally overheat. Thanks for diving in with us.
Stay sharp out there.